Welcome to the Delaware Mortgage Rate Weekly Mortgage Market Update for the week of November 10th, 2014. Hello, I'm John Thomas with Primary Residential Mortgage, here to give you an update. Well, last week was a good week for Delaware mortgage rates. They were able to end the week a little bit lower than they started. If you take a look at the bond chart on the screen, you can see the trend has been for mortgage bonds to sell off, moving interest rates higher. But that trend reversed on Friday. You can see the big green candle there. What happened was the release of the October jobs report. Bond market rallied, and now the short-term trend is for bonds to trade higher, which is for interest rates to move lower. So based on that, we're going to recommend floating your Delaware mortgage rate to start the week to see if the bonds can continue on the short-term trend of moving higher and moving interest rates lower. Now, if we dig into the economic news last week, what caused this change in mortgage bonds? Well, it was on Friday. The October jobs report was released by the Labor Department, and they were expecting 235,000 jobs to be created for October. They got less than that. They only got 214,000 jobs created. And then when we dig into the report, those jobs that were created were in the bars, restaurants, and retail sector, and that's what we would expect this time of the year. So there wasn't good, meaningful job creation. So based on the missing the number and then digging into the report, stock market started to sell off, rallied the bond market. Now, if we dig further into the report, the unemployment rate did tick down slightly from 5.9 to 5.8%, but the labor force participation rate is still at lows not seen since 1978. It's at 62.8%, and that measures the number of people 16 years or older eligible to work. They're actually working. So mixed report there on the jobs report. Stock market didn't like it. Bond market benefited. We had a big rally, and we're going to see if that rally can continue this week and move interest rates lower. And then we also saw that wage growth was in that report as well. Wage growth remains tepid, only 2% increase in wage growth for the year nationally. That is really low for recovery. We need wage growth to kick in to get consumer spending to kick in, which will help this economy recover. So we're going to have to watch to see if we can get some wage inflation. Then we saw other economic news. The price of oil broke below $80 a barrel last week. That's pretty historic. We haven't seen that in a long time, and we're feeling that at the pump. We can see gas prices locally here in the $2.70, $2.80 range. So that is like really helping out families. That's going to keep inflation low as well. So that's going to help mortgage bonds trade higher because inflation is the enemy of bonds. So oil moving lower. What's caused it? Well, we have a strengthening dollar. World economies aren't doing well. That's helping strengthen the dollar. Oil trades in the dollar, so as the dollar gets stronger, the price of oil will drop. The other factor is world demand for oil has dropped, and the U.S. is producing more of its own oil, so it's not buying as much on the world market. And then Saudi Arabia has increased production, so that's also increased production, more supply, drops the price as well. So that's what's going on with oil, and it's really helped us here at home. It's also keeping inflation down. Then we had the weekly initial jobless claims on Thursday. Came out, they fell by 10,000 claims down to 278,000 claims. That's the 8th week in a row of claims below 300,000. And the 4-week moving average for jobless claims fell to 279, which is a 14-year low. So great news there on jobless claims. That bodes well for the labor market. And then in housing news, CoreLogic released their Home Price Index report for September 2014, showed year-over-year home prices were up 5.6%. That's a slight drop from August year-over-year of 5.8%. So that's showing that home price appreciations continue to slow, so the housing market's slowing down, but we're getting into a range that's more manageable over the long term. Annual appreciation rate over the last 30 years is 5 to 6%, so we're right in that range now. So we'll have to see if that can hold. And then in the local news, the next free first-time homebuyer seminar is Saturday, November 22nd. That is in Newark, Delaware at the Christiana Hilton Hotel from 10 a.m. to noon. And the next one in Dover is Saturday, December 6th, 10 a.m. to noon at the Dover Holiday Inn. Now, you can register for either one of those events. Give us a call in the office at 302-703-0727, or you can register online, www.delawarehomebuyerSeminar.com. Look forward to seeing you guys next week.